Welcome to Investors Insights. Our topic today is market seasonality. We thought that was an appropriate topic and wanted to introduce you to it, mainly because of the fact in this time period of April, people are always saying, oh gosh, the time change is killing me. Oh gosh, my allergies with pollen is killing me. Well, guess what, folks? There's market seasonality as well. And we hope we educate you on that this morning. I am joined by my distinguished colleagues, Ty Miller, Bobby Norman, and Trey Booth. And I think we've got some great insight for you as we begin this month of April. So with that, Bobby, you really started us off this morning with market seasonality because historically, April has had some positives. Is that correct?
That's correct. Yeah. So, March was a volatile month. No doubt about it. But seasonality patterns prevailed as stocks performed well in the last half of the month. And as you can see in this first chart here, historical April seasonality trends suggest the positive momentum seen last week in March could continue. And so since 1950, the S&P 500 has posted an average of 1.5% growth in the month of April and has finished positive during the month 71% of the time. No guarantees, but we like those numbers. Also, as you can see in the second chart here, the first half of April is usually strong, with the first 12 trading days historically climbing 1.5%. So while there are still concerns about the Federal Reserve slowing the economy down and continued fallout from the banking crisis, higher oil prices that Trey's going to talk about, having to consider all these things, the market is showing strength in historically a strong period of the year. So no guarantees, but this is a positive development that gives us continued hope that the strength seen last week can and will continue.
Well, it's something we're going to keep all our clients updated on our social media, as well as these vlogs, LinkedIn, Twitter, Facebook, podcasts. With that data you gave us, I guess in essence, we're saying, will history repeat again for the month of April here? We would like that. And also from the standpoint as someone who started his career in the early 80s when inflation was going wild, we now are back in an inflationary time period from looking back at history also. And also, what was the impact of energy prices during that time period of the 70s and also early 80s. So, Trey, this morning we got an announcement overnight that OPEC made some decisions. Talk about that in relation to what Bobby's discussing and also the impact that has on interest rates and inflation.
Yeah, absolutely. In a surprise announcement, OPEC is cutting oil production to the tune of nearly 1.2 million barrels a day. That's in addition to the 500,000 barrels a day that Russia announced they're taking offline. And then back in October, OPEC announced they were going to cut roughly 2 million barrels. So altogether, that's around 3% of the world's oil production coming offline. And Saudi Arabia announced that cut will go into effect in May, which is just in time for another season, driving season around here in the U.S. The summer driving season is when we use a large percentage of our annual gasoline usage. And so oil prices have immediately reacted. They're this morning reaching as high as $81 a barrel. They were as low as $66 earlier in March. And so the oil market's reacting very quickly to this news. So why would Saudi Arabia cut? Why now? Why the surprise announcement? Our research group partners at Strategas put out this chart, which I think is helpful in explaining what Saudi Arabia is looking at. They gave this to us a couple weeks ago, and it's extremely topical now. You can see here, this is the price that each country in OPEC needs to balance their budget. So it's not just the cost. When we hear here, we think of our companies and what their cost per barrel. That's how much it is to get it out of the ground. Well, most of these OPEC countries run their entire country on oil. So this is their break even, not on production, but to balance their entire economy. You can see Saudi Arabia, which is the largest producer, is right around $67 a barrel is what they need to balance their budget. That's just in line with right where we were in mid-March. So this cut is more of a point of survival for them. They've got to get their budget aligned, and so they've got to reduce their production just to get prices back up. This is where Saudi Arabia needs prices to be. This is a big change from back in 2014 and 15, where the U.S. was the swing producer and Saudi Arabia was trying to cut oil production to boost prices. That's not having the same effect back then as it does now. Now we're seeing, it's kind of to Greg's point, back to the oil shock of the 70s, where these OPEC countries speak and the market reacts immediately. We got into a time period there where the U.S. was the swing producer. That's not the case anymore. Saudi Arabia is back to being the swing producer. So when they speak, the market clearly listens. And so we may see some higher gas prices, not immediately. This will start impacting us maybe May and June. So just keep an eye out for that. And something we're internalizing here when we're projecting out where interest rates, inflation, the Fed may go going forward.
Yeah, it's something that we're going to watch closely because the Fed will have to pay attention to this as well. Correct?
That's right. This is an early indicator. It'll start bleeding through the economy, as we saw back when oil first spiked back in 2021. It took a little bit for that price spike to get through the economy. This will take some time, but this is an early indicator that maybe inflation is not in the downward trajectory as we were hoping. So it's not set in stone that this will cause prices to go higher. It's just something it'll be a big indicator we'll look at, when we're looking forward.
Yeah, and I want to emphasize to our viewers, that's very important. I mean, keep in mind, we woke up this morning to get that news. And so that news in relation to other research we had done, and Ty, I want you to talk about the fact that, prior to this announcement, we were looking at possibly where interest rates would start to come down, correct?
Right. And so March marked the 1-year anniversary of the tightening cycle. It's been a long year. Feels like we've been tightening for a long time and at a rapid pace because we have. This is the fastest tightening cycle since the 1980s. Coincidentally, it's the first time that stocks haven't been up in a 12-month period since the first rate hike, since the early 1980s. So looking forward, what can we expect? Well, as you see in this chart, which again, as Greg and Trey alluded to, this was released before the OPEC news this morning. Inflation was projected to come down enough where the Fed can kind of raise rates without actually raising rates. How do they do that? As you see here, the Fed funds rate is expected to be 5%. They don't have a meeting in April. The next meeting's in May. We're looking at, according to this, a pause right now. Again, this is probably OPEC, but that's because inflation was coming down. And so Trey's mentioned it tons of times that, we want the Fed funds rate to be above the inflation mark. That's kind of historically where we see a pause. Not a cut, but at least a pause. And, we're projected to get that in this month, as long as this OPEC news doesn't swing too much. So be interesting to see how we go forward. And maybe if we can get inflation down enough, obviously that'll help the consumer. And then, kind of flatter rates. You may, see that in your mortgage payments, your car payments, things like that, where your rates finally start going up and they kind of plateau.
Yeah, and so that's something we're going to be navigating through and looking at all the data this week and on into the rest of the month of April, keeping our clients updated. Because when you have this come out of nowhere, our data was showing that inflation was slowing up, and now we'll have to rethink that in our analysis and also tie that back to our clients' financial blueprints as well as portfolio allocations. It may be a blip, but when they do something like this, as proven throughout history, it can at least have a short-term effect. So great research, gentlemen. Really appreciate all your work and effort on that. Folks, hopefully you've gotten some good insight on this, that we've gotten information to you. Always remember this, that watch these vlogs because we want to emphasize to you what's important to your portfolios versus what's the emotion and the headlines out there in the media. We're going to keep you updated. We hope you have a great week, and we thank you for believing in us. And know every day we walk through these doors, we're striving to help our clients have a better, richer, fuller life. Thanks again. Talk soon.